home. But I still love you guys because I am rocking my Credit is Power t-shirt. If you do not have one and you want one, if you are a credit nerd the way that I am, or the way that the way Michael is as well, and you want a t-shirt, let us know in the comments section, and happy to get you guys a t-shirt sent your way. May take a while because of shipping issues and supply issues, but we'll get you a shirt. Don't worry about that. So we're gonna allow a couple seconds here to get some folks on. Let me know if you are live, if you're catching this. Let me know where you're from, what you're up to. We'll get started in here in a bit. I'm making sure I got everything right on my side. What we're going to do is Michael's going to be dropping some questions that came in the comment section. I'll get those questions answered live for you guys. We'll keep the recording, we'll keep the live stream up for a while. Other than that, let's go ahead and get into it. So I'll kind of start off with a general topic and kind of my belief, my position on credit being powerful that it is, and of course that's with the current credit system, FICO scoring, Vantage scoring, three main reporting agencies, that whole entire ecosphere of players that are all involved around consumer credit. I do believe that that is a very powerful system, and to the average Joe, no pun intended, and that's out there, you can really leverage if you know how the credit system works. You can really leverage the credit system to get access to capital, to be able to do things for yourself personally, or even for your business, to really grow multiple streams of revenue, from investment properties to businesses. The banks want to be involved in those transactions because they want to make money on the interest. They want to lend money in a less risky way, and they like lending in the form of asset-based lending. So if you're buying investment properties, if you're buying businesses, banks love those things as long as it meets all the criteria. It's more profitable for a bank to be involved in those scenarios. And so for you, what does that mean to you? Well, if you're trying to develop multiple streams of revenue, having access to credit like that can allow you to take down investment properties. Give an example. I've recently purchased a little property in East Downtown Houston. It's going to be a short-term rental. It's gone live here recently. Made a couple $1,000 already just off of some bookings because I just put it on Airbnb. Now I didn't use any of my own cash to secure that property. It was a $500,000 property, nice property, little four-story house, or townhouse, whatever you want to call it, and nice view of downtown Houston, the skyline. And I did not use my own cash to take down that property. Um, I used bank financing. It was 20% down because most banks for investment properties want 20% down. But I had access to a $100,000 line of credit. So I used that line of credit to cover the down payment on the loan, the 20% down. And, as mortgage payments are due, my Airbnb um, bookings are going to more than cover the mortgage, the insurance, the what else? Electricity, gas, cable bill, all that more than, the cleaning bill, all that more than covered by the bookings that are bringing every month. And I didn't use any of my own cash to take down that property. So that's an example of credit being very, very powerful. So, Michael, if you would go ahead and maybe drop a question in the comment section here. I don't know if that is you. Let me just maybe message him on Slack. Ready for a question, and he'll get that plugged in there. Plug it into the comment section. Let me let him know. Let me see if he sees me. Do you see me live? All right, cool. As we wait for that, let's see another thing going on in the credit world. Oh, the Consumer Financial Protection Bureau and the CDIA, which is the trade is the organization that was put together by Experian, Equifax, and TransUnion to be more compliant or appear more government friendly. They want to work with the government and they want to be cool and all that. And so they really hate credit repair industry. They really do hate that industry because yeah, they just hate the disputes. They really hate the complaints that are coming through the CPP portal, which I'm not a fan of. My company, the credit agents, we don't do that. We don't want to make things more expensive or harder on the consumer because if the CPB puts more pressure on the consumer reporting agencies, Experian, Equifax, and TransUnion puts more pressure on the bureaus, and then the bureaus make it harder for the consumer to dispute things on their credit, or gain access to credit, or just yeah, really make it harder for a consumer to you know to work on their credit or get access to their credit report. Then ultimately that does help, that does increase the cost of credit to consumers. Um, Maybe not directly, but definitely indirectly, it'll have an impact on that. And so um, okay, got a question here. Michael's question that he posted is, how many credit cards are good for your score? That's a good question. So there is, there's not a certain number of accounts. There, there, there is a minimum, right? So I mean, you definitely want to have at least one. Having zero credit cards, zero revolving accounts is definitely not good, meaning it doesn't display an accurate picture of risk on yourself because a revolving line of credit or a credit card, if you will, is going to have there's a couple characteristics with the credit card. There is the balance, there is the credit limit, the monthly minimum payment, history, and all that. Main important one is credit limit. And so when you don't have a credit card period reporting to your credit report, you don't have any available credit. If you have some car loans or installment loans, personal loans, things like that, um, that your credit limit or really would be like high balance, which would be like the highest that the balance was at the time you originally financed at. But when it comes to how much available credit you have, that doesn't apply in those scenarios. So having installment loans like car loans and things like that, although you do need them, you don't need a lot of them, but you do need some to help with their credit building. You don't really gain anything under that available credit component of a FICO score, which is about 30% of a FICO score. Not about, it is 30% of a FICO score. So the only way you tap into this component, which is basically almost a third of your credit, is to have open credit. Oh, is to have open credit cards because credit cards have credit limits, and so the more credit limit you have, the more accounts you have, um, the more credit cards you have, the larger your overall credit limit's going to be. And then depending on the balance you maintain individually and overall is going to determine what your utilization rate is, what your usage is, and that's going to have an effect on um, on your credit score. So if you have zero, it's definitely not good for your score. But if you have way too many, it's really not problematic until you just have too much that is outside of your control, meaning you can't afford to pay them down quickly, or you just can't afford the minimum payments, and then it kind of gets out of control, and then your available credit is very very minimal because your credit cards are, for the most part, are all maxed out. But if you have like 5 cards and always paid on time, balances are modest or they're low, that's good. You could have 20 cards. You can have 50 cards if they're all treated equally, meaning or there's nothing out of the norm like maxed out cards, over the limit, missed payments, then you can have as many as you want. For example, I have 7 cards on my personal credit, and God knows how many in my business, but I know I have the Apple Card, I have an Upgrade card, Capital One, it's three, Credit One, Open Sky, my very first secured credit card, and Firestone, Zales, and I want to say that's it. So I think I have 7 cards total, and all of them are high limits, low balances, except for my secured card. Not really a high limit because it's my first secured card I got when I was like 18, like a $300 limit, but my balance is really low. My balance is zero on it because I don't really use it. But you know, you can have as many as you want as long as you are using them appropriately, responsibly, not maxing them out, not missing payments. So the answer to the question, how many credit cards are good for your score? Um, it doesn't really matter the number, except for zero, right? You can't have zero. Zero is bad. Zero is not good for your credit score. Um, you know, I would say I would say three or more is fine. It's definitely good, because you also have to think about the component of your FICO score called mix of credit, which is 10% of the FICO score. So mix of credit deals with how you handle multiple types of credit accounts. How do you handle an installment? How do you handle a revolving account? How do you handle a mortgage? How do you deal with multiple type of accounts? And so, you want to be able to demonstrate you can handle multiple installments and multiple credit cards, no problem. You can diversify your credit, no problem. And so that's where, again, you don't want to have zero credit cards. If you're really trying to raise your score, zero credit cards is not going to get it done. You want to have, at least one. My rule of thumb and how I view maybe, what is a good mix of credit or a good blend of credit. I would say one installment loan and at least three revolving accounts. Three credit cards on your credit report. Okay, next question. When is the right time to close out a credit card? Very, very good question. Kind of tricky too. So when we're looking at your length of credit history, okay, so length of history, so some subcategories to that, such as average length of history, and it's probably the most important part, which is your average length of history. So what I mean by that is your average length of history is very important. You have to pay very close attention to that. So let's say that you have 5 credit cards. All of them are at least 5 years old. So let's say your average length of history is 5 years. All right. Well, if you close one of those out, your average length of history really would not decrease because your average length of history is already 5 years. So if you have 5 accounts and you lose one, and the other four are still at 5 years, then your average length of history is still 5 years. It hurts to close your account if that one account was really helping your overall available credit, and you close that account out. So now you go from, let's just say, $30,000 worth of available credit. Now you're down to $25,000 worth of available credit, and your balance at the time you did that was like $10,000. So, excuse me, I'm gonna take a swig of water. You had like 33% utilization. You had a 33% utilization rate prior to closing the accounts out. Then once you close the accounts out, now you're at $25,000 worth of available credit. Your usage is closer to like 40% at that point. So closing out an account would hurt your available credit component of your score. Um, Now, when is it a good idea to close the account? Is, let's say that you had the same scenario, 5 credit cards where all of them are 5 years old, average length of history is 5 years. Then you open up a brand new credit card for like $300 available credit, a real small one, and it's only been open for a month. Well, that's going to decrease your average length of history to probably like 4 years and some change. I'm going to pull up my calculator here. So let's just say 5 times 5, that's 25. and then let's say you got 25 divided by 6, yeah, it'll decrease your average length of history to like 4 years and like 2 months, right? So that would be a good scenario where to probably close that account out, because you don't want that account really building up going too far and building up the payment history, because it's going to drive down your average length of history. You really want your length of history, your payments, and all that going forward. You want to try to keep it as old as possible, as aged as possible. So that is my opinion on when it's the right time to close out a credit card. Is if you got it too soon, you don't really want it, it was like a impulse purchase, close it out right away, get rid of it, because it's going to hurt your average length of history. Okay, another question. Michael says, I've seen a lot about the extra cards. I was thinking about closing one of my older cards and getting that one instead. That kind of tie into that previous question. You got to be very careful with that, because it will decrease. It could decrease your average length of history depending on how old those older cards are. And then that extra card is going to be a brand new account. I would recommend just doing both. Just having it all. Don't if you really want that extra card, don't close out the oldest one, or don't close out any cards, especially on an older card. Keep it open and just get the extra card if you really want it. Now keep in mind your score may go down because of average length of history, but if it adds a lot of available credit to your credit report, then it's not really going to be a big issue. Um, Another question. I'm going to start my credit journey pretty soon, and I want to know which is the better option. Should I start off with a secured card or the extra card? If you have zero open credit whatsoever, my answer would be do both. Definitely do both. The more, the merrier when it comes to building credit. Now, if you already have an account already, like you already have a secured card, then just add on the extra card. If you already have a revolving account, maybe an unsecured credit card, add on the extra card. Give that one a shot. But if you have zero open credit whatsoever, add them all. Add both. Do both if you can, because the secured card is going to be a deposit. You'll put down $200-300, borrow against it. It's going to be a revolving line of credit, and then extra card you pay. Um, you basically are paying for the purchases that you use on the extra card, and the credit limits is determined based on what your available bank balance is in the very beginning, and your limit is going to be based on that. And so your limit can really fluctuate there. So do both, but your upfront cost to get an extra card is not as much as a secured credit card. So however, again, going from zero open revolving credit to two accounts right away, that's definitely you're definitely gonna speed things up in your credit journey. Okay, another question is it really possible for a card to really be both debit and credit, especially since it doesn't even require a credit check? The extra card is popular. I'm glad we talked about that with regards to the extra card. So is it both debit or credit? Okay, so the extra card, the way that I interpret it, it's not a debit card. It's a credit card, but the limit is not based on your credit rating. It's based more on your bank balance, and it's linked directly to your checking account, and they have authorization to pull the funds to cover the purchases for that previous day, you know, the next day, right? So they're not really waiting too long to get their payment. So therefore, this company is more willing to extend risk because they're not also really extending credit per se. You're extending your own credit by what purchases you're using on that card, and then as long as you're paying it back the following day when they debit your account. So and then when you go to it just kind of feels like a debit card because of that reason, because your payments are being deducted pretty quick, whereas a real debit card, usually your when you swipe your card, it's sends notice to Visa, Mastercard, whoever, They authorize the transaction. I mean, they're checking. There's like a lot of different players involved with that communicate all that information. Um, but pretty much instantly know if you have the funds in your account or not to approve the purchase when it comes to a debit card. With the extra card, they're not going to check your bank to see if you have the funds to cover that purchase. They're just going to do the purchase, and then you're just going to pay whatever you use the following day. Now, if you overdraft or you don't have the funds, that's going to be a different story. They're going to probably still try to debit the amount. Of course, they're going to continue trying to debit the amount, but if you don't pay it, then over a period of 30 days or more, then that's going to be considered a late payment. Okay, so another question. What would you recommend for somebody who can't pay for credit per service but wants to improve their scores fast? Well, we have a couple of things going for that. There's Blueprint, 97 bucks. It's basically compressed do-it-yourself credit repair course, everything that you need to definitely get off to a fast start when it comes to repairing your credit. That is in the Credit Score Blueprint. You go to creditscoreblueprint.com, 97 bucks, sign up for the course, and you can get letter templates, videos, and training. And I put it together, so it's me explaining what to do step by step and how it all works. So that's one way to save some money. And I think we have the 30-day challenge coming up again soon, where you can if you're selected to get into that group, then you can get also off to a pretty fast start, at least a 30-day fast start at no cost. That one's actually done completely free. Um, so, and then for me to kind of explain the step-by-step process here right now, it's kind of complicated. That's why I put everything in that course. So, everything is centralized, and you can go step by step by step and do all that. So that's what I would recommend if you're dealing with a financial concern, you want to repair credit, don't want to pay for credit repair. Check that out. More than welcome to check out creditscoreblueprint.com. Okay, Michael, do we have any more questions coming in? If not, we're going to go ahead and call it. I appreciate everyone being on here. I know that we had some technical difficulties earlier, so definitely do appreciate that. Okay, got another question. Thanks, Michael. What are some of the red flags for illegitimate credit repair services? Oh man, that's a good one. Good question. Okay, so I would say there's a couple ways to detect red flags. So first off, let's start off. Okay, Michael said this is the last one. Okay, so let's start off with where are they doing business? Like what state? And then you can easily check up. You can do a Google search like credit repair requirements for whatever state you're in, and they have certain states have certain requirements. Like for example, in Texas, you have to have a license, right? So you have to have what's called a credit service organization's license, and then you have to have a $10,000 surety bond in order to perform credit services. And so that's Texas. Louisiana, they want registration, no license, but they want you registered that you're doing business in that state, and they want a $100,000 surety bond. So every state has different rules and regulations, and so you can ask that company if they are licensed or registered or bonded, depending on whatever the state actually requires. Now, if they're missing some of those things, that could be a red flag. A really reputable credit repair company is going to obviously want to be fully compliant with state and federal rules and regulations. And so if they're not paying attention to that or not really caring, then that kind of tells you something a little bit about their organization. Meaning that maybe they don't care about the rules, or maybe they're just negligent over the rules, and that's not a good sign. Um, a couple other things too would be if they charge for their entire services up front. So like a flat fee credit repair service, you know, they don't have any ongoing fees, or they don't have, you know, maybe charge per deletion. That's what we do. Maybe they want $1,000 or $2,000 up front before they begin services. That would be a red flag. It's kind of like the contractor rule or the mechanic. You wouldn't give a mechanic your car and give them $2,000 up front and say, okay, let me know when it's finished. You run that risk of you never hearing from them again. They already got the money. What's the incentive for them to do a good job? So that definitely applies not just in credit repair, but also in many industries. I'd say another red flag would be the police report, the fake identity theft credit repair process, where they have you falsify a police report, meaning or just doing a false police report, or a false um, FTC identity theft affidavit. Basically you're committing perjury. You're lying that it's identity theft. And then you send that to the credit reporting agencies and you say, hey, remove these accounts that are identity theft, and you know that they're really not. Um, that's a red flag if the organization does that, because they'll using that they'll get the items off your credit, and those type of organizations typically would charge $1,000, $2,000, $3,000 up front because they know they're going to get the items off. But it's actually it's doing it in a shady way, right? Someone's going to get in trouble. In fact, there was a company out in Houston that got in trouble for doing those kind of things. You can't do that if you're making a statement, um, if you're attesting that what you're saying is 100% fact, and if it's not, it's punishable under the court of law. You're making a false statement. Then that you don't want to put yourself at risk by making a false statement like that. Say these accounts are identity theft and they're not. Give it time. The right regulatory agency is going to catch on to that, and someone's will get in trouble. So um, those are the things I definitely would say are red flags in the industry, and you want to pay close attention to and really try to avoid. Okay, we'll end on that. Michael, thanks for posting the questions. I hope you guys enjoy that. So I am out of here. I'll see you guys next time on the next live. Hope you guys got something out of this, and I'll see you next time. Take care.